Welcome back to the Risk Manager's Corner. In this episode, we're talking about the regulatory framework behind insurance, specifically how solvency works, what regulators monitor, and how insurance firms manage their capital, risk exposure, and long-term stability under regulatory oversight. This isn't just compliance. This is survival architecture, what keeps insurers standing when losses mount and volatility spikes. Let's break it all down. Why regulation matters. Insurance is a promise to pay in the future, sometimes decades into the future. That makes trust and solvency foundational to the system. Unlike banks that manage liquidity and credit maturity mismatch, insurers manage long-dated liabilities, uncertain claims, and event-driven risk. So, regulation in insurance is focused on ensuring capital adequacy, promoting prudent underwriting and reserving, protecting policyholders, enforcing sound risk governance, maintaining systemic stability. Without strong solvency rules, one insurer's failure could disrupt trust in the entire market. Key components of insurance regulation. There are 5 pillars regulators typically focus on. 1. Licensing and supervision. Insurers must be authorized to operate by a national regulator. This includes minimum capital requirements, fit and proper testing for executives, business plans and governance structures, ongoing supervision of financial condition and operations. 2. Solvency requirements. This is the heart of regulation. Solvency equals the insurer's ability to meet future claims. There are 2 core elements. Technical provisions. Properly calculated reserves for expected liabilities. Capital requirements. Buffers to absorb shocks beyond expected losses. 3. Investment regulation. Insurers can't just invest premiums however they want. Regulators enforce asset diversification rules, limits on risky or illiquid assets, matching of asset duration with liability profiles, local currency concentration thresholds. 4. Governance and risk management. Modern regulation requires a formal risk management framework, independent risk and audit functions, clear roles, escalation protocols, and risk appetite statements, stress testing and scenario analysis. 5. Disclosure and reporting. Insurers must provide regular solvency and financial condition reports, risk assessments, detailed reserve and capital breakdowns, external audits and actuarial validation. Solvency capital. What it means. Solvency capital refers to the amount of capital an insurer needs to hold to cover its obligations with a high degree of certainty. It's not just about staying above zero. It's about having a statistically justified buffer that can withstand large losses or tail events. Different jurisdictions use different solvency frameworks, but most follow risk-based capital models. Solvency II. The European benchmark. One of the most influential frameworks globally is Solvency II, introduced in the European Union. It's built on 3 pillars. Pillar 1. Quantitative requirements. Calculating technical provisions. Setting solvency capital requirements. SCR. Using a standard formula or internal model to quantify risk. SCR covers underwriting risk, life, non-life, health. Market risk, credit to counterparty risk, operational risk. There's also a minimum capital requirement, MCR, below which regulators intervene directly. Pillar 2. Governance and supervision. Requires insurers to run an own risk and solvency assessment, ORSA. Forces firms to evaluate their capital needs based on their own risk profile. Ensures strong internal controls, board oversight, and risk culture. Pillar 3. Disclosure. Public reports on solvency condition, transparency for policyholders, investors, and regulators. Solvency II is complex, but it forces insurers to quantify, understand, and disclose their full risk profile. Global equivalence and local adaptations. Not every country uses Solvency II, but many have aligned with its principles. Examples: Kenya and South Africa. Risk-based capital regimes in development or implementation. United States, NAIC RBC model. Japan, solvency margin ratio. China, C-ROSS framework. Australia, APRA's prudential standards. All aim to measure insurance risk, market volatility, credit exposure, operational fragility, and ensure insurers carry capital proportionate to risk. What risk managers must track. For a risk manager, solvency regulation isn't an accounting checkbox. It's strategic. You need to monitor capital adequacy under base and stressed scenarios, validate reserve sufficiency with actuarial input, align reinsurance structures with capital planning, ensure investment risk is matched to liability structure, lead or challenge the ORSA process. ORSA isn't just paperwork. It's your chance to define how much risk your firm can realistically absorb. Stress testing and scenario analysis. Most frameworks now require forward-looking stress testing. This includes catastrophe losses, investment portfolio shock, mass lapse events, reinsurance counterparty failure, regulatory capital degradation. Stress testing should be board-driven, documented, and embedded in planning cycles, not just a compliance ritual. Regulatory triggers and intervention. Regulators don't just monitor, they act. If an insurer breaches its minimum capital requirement, regulators can freeze new business, force recapitalization, restrict dividend payments, place the firm under administration. This is why proactive solvency management isn't optional, it's existential. Final takeaway. Insurance regulation is about more than compliance. It's about long-term viability. Solvency isn't a number, it's a strategy. Capital isn't a buffer, it's your last defense. And ORSA isn't a report, it's a reality check. So ask yourself, are we solvent under stress? Do we understand our true risk drivers? Is our governance real or performative? Subscribe and stay sharp. We're not here to check boxes. We're here to build resilience.